Howdy, Jacob here. Today we're looking at CNX Resources, oil and gas consumable fuels industry with a 3.2 billion market cap, 5.1 billion enterprise value. Been around since changed its name in 2017. Okay, founded in 1860. A little bit of time, I guess. No dividend. Growth is negative, but really just wildly all over the place. Let's see if there's just a bunch of divestments. Nope. So this is just an extremely seasonal, volatile, wildly crazy business where you can go from 3 billion 1 year in revenue to 800 million the very next year, and then a billion, and then 2 years later 3.9 billion, and then next year back down to 1.5 billion. So we're looking at one of the most wild businesses ever from a volatility standpoint. And weirdly enough, on an earnings standpoint, I guess not weirdly enough, they've made $9 earnings per share this year, negative 243 3 years ago. 2018, $3.71. So we're definitely going to be using averages here to value the business. But gross margin, something I really don't like is that, even the gross margin is not consistent. I don't even think at least the gross margin would be somewhat consistent, but even that is, it's because revenue is changing so much. Okay, so cost of goods sold isn't changing that much, but just because revenue is so well. Okay, that doesn't make sense. So, all right, let's look at some different statements here. So the balance sheet has no cash, zero, less than $1 billion in cash, with just under 2 billion in long-term debt and 326 million short-term debt. Oh man, that is troublesome. So let's say 2.3, 2.2 billion in debt, and a 5 year average free cash flow. I mean, you got negative 200 million, but as high as 800 million. Probably averaging out 400 million, let's say. So on 400 million, that is just over 5 times. So it is a good amount of debt, and with such a volatile business, you would really want this company to have some cash on hand, based on the fact of, they don't pay a dividend, but like based on the fact of they're just so volatile, they're going to need to go to debt to fund anything that they want to do. The use of cash is kind of interesting here. So we see probably more debt repayments than issuance. So that's good that they do know they have debt, but haven't paid a dividend since 2016. Only one acquisition in the last 10 years. Outside of that, it's just when they make money, they buy back shares, or even when they don't make money, they buy back shares. Okay, interesting. So the use of cash is really just share repurchases, well above stock-based compensation. So we're going to be seeing a good amount of share buy down, and we do see that 230 million shares outstanding in 2014 to now 162 million. So if you're buying back really cheap shares, this can be an absolutely fantastic way to create an immense amount of value for a business. I know the most common ones are NVR and AutoZone, where they really just doubled or tripled, maybe quadrupled uh, their earnings and revenue, but on an earnings per share basis, they bought back 90% of shares, and they're 100 baggers, meaning 100-fold times your original investment if you would have kept on with the business the whole time. So share repurchases can be fantastic, but one, they're not buying back an immense amount of shares. This isn't even cutting it in half over a 10-year period, and it's just such a volatile business. I wonder if they're buying back cheap shares when they're really cheap, or just when they have money. And usually when businesses have a lot of money, at least cyclicality wise, they look cheap from a PE standpoint, but from a 5 year average standpoint, it's probably one of the more expensive times of the business, since a lot of investors are very short-term minded. So if we're here to make some assumptions, I would say that on the revenue growth standpoint, 3%. I'll just say 3 and 13 on the PE price free cash flow. It's usually my go-to if I just have no idea. I'm saying, hey, they'll grow somewhat with inflation, and then at the end of 7 years have somewhat of that same growth out of them. Maybe, sure. And then margins, I mean, we have over 100% and then zero. So we'll really just be taking averages here, and it'll be a pretty wide range. Let's do maybe 20 and 12 and maybe 2015. Yeah, 15%, 20%. And then let's say that they buy back 3% of shares would be about a billion. I mean, they can't afford that. Wait. So that would be 30 million, 100 million, 100 million, 3 years. Yeah, they can afford that. So this is saying that reinvestment, it'll be a little bit of their free cash flow, and then otherwise just share repurchases. I might even do 4% because that'd be about 120 million. It's fake math, but all I'm really doing is saying what's the current market cap, what would 3 or 4% be, and how much would that be in comparison to their free cash flow. So um, I mean, I think 4% would be reasonable. They don't really use their cash for anything else. So I'm saying that maybe they'll now have money to gain a cash balance, and then maybe they'll have buying opportunities for acquisitions, reinvestments, purposes. So I'm comfortable with that. So this gets us to a price point that still needs to fall 38% before we get a 15% return with these assumptions. So right now, it's a very cyclical business. Cyclical businesses can be attractive when they're at their trough of cyclicality on the stock point perspective, because like I said, most shareholders are short term, and so it might look bad in the near term, but cyclical business will come right back up. So um, right now, it's just not there for me. But not to say it won't in a little bit. So hopefully everyone enjoys the video. That's the rest of the day. Thank you.